G'day, welcome to the Australian Property Podcast. I'm Pete Wargent from Alan Wargent Property Buyers. I'm here with Chris Bates from the Alcove Mortgage Group. G'day, Chris. How's your week been?
Oh, it's been good, Pete. October 1, so I guess we're in the Q4 of the year right now. You can see it all over the papers, the 5% deposit scheme. We sort of talked about this for many months and how the news would all get behind it on the 1st of October. So that's absolutely happened. The weekend was good here, Pete. We went camping with a few dads. It was good. We did some fishing, went for a long hike. My mate's a chef, so we just cooked up a huge feast on the barbecues there. And it was good fun. It was nice, but I kind of missed the kids. It was the first time I've been away as a group of dads. And as soon as I got back and 5 minutes in the car and they were fighting in the back seat, I was kind of like, what was I missing it for? This weekend's a long weekend up in Sydney. So actually going to the Blue Mountains and take advantage of the Monday off. And it's a nice time to go up there. It's not the peak of winter where you got the fire on, 24/7. Hopefully there's a bit of a sort of a spring feel up there. How have you been, Pete? I hear in chilly Melbourne at the moment.
I'm in Melbourne this week. We went camper vanning last year. We kept coming down from Cairns to Sydney. We actually did a couple of nights in the Blue Mountains. I think the kids were a bit shocked actually because they said, I thought it wasn't cold in Australia, but it's like, yeah, it is in the mountains. So definitely take a blanket. Yeah, I've been down in Melbourne all week actually. So obviously football grand final, long weekend just gone. So I won't bore everyone with football chat, but so proud of the team, second year in a row, just brilliant performance by Brisbane. It's been good. I've caught up with a few people in Melbourne. It's a bit hard to get a read on what's going on at the moment with the long weekend, and then it seems that Thursday night is the new Friday with people taking that extra day working from home. But everything seems to be sort of buzzing along, and you can see sentiment seems to be solid enough. Had to catch up with a couple of buyers agents down here, Kate Bakos, who's my co-author from last year, and it's interesting to hear that they've been pretty busy, particularly with some first home buyers getting in ahead of this 5% deposit scheme, and apparently prices moving in that bottom quartile of the market. So just like Sydney, Melbourne has had has made a few moves to try and increase supply in certain zones, trying to sort of get more supply coming through. But at the moment, obviously demand is very strong with people moving back to Melbourne post-pandemic. And it seems that the market is being driven from the bottom up because first home buyers are coming in. As you mentioned, we're recording this on 1 October, so the 5% deposit scheme is across all of the headlines today. And I guess that will be the theme running into the end of the year. I was interested to get your thoughts on this, Chris. I was reading Justin Fabo from Antipodean Macro and formerly of Macquarie, and she was saying if you look back to when the fringe benefit tax exemption came in, and there was Treasury estimated that only 4,700 drivers would take that up, and it's kind of 100,000, massive underestimate. If you think back to the COVID era and the home builder grant, do you remember in the early days when people were saying, this policy is going to be a real fizzer and nobody will take it up, and then there was 114,000 grants in the end. I just wonder, Justin's questioning whether Treasury might have underestimated the impact of this 5% deposit scheme. They think that in real terms there won't be much of an impact on housing prices, but I guess in the environment of lower interest rates and a massive housing shortage, maybe they've underestimated how many people are going to take this up and the second order impact of the FOMO that might create.
Oh, I think he's bang on. A lot of people do say, people can't, even if you got a 5% deposit, you're going to have a huge mortgage. People won't take that up. They absolutely will. And I think particularly when prices start rising, the first home buyers were more, be keen to sort of jump in before it sort of starts to run on them. I think that, I'm not sure if it's Treasury or the RBA or who exactly is putting out these forecast numbers, but I've read them and they're like 0.5 to 1%. And I think that's very undercooked. I think particularly if you look at a local market level where first home buyers are buying, I think you'll find that it's much greater than that in weeks rather than months. And I think you've actually took the headline out of my blog that I've got to write for Friday, Peter. I've got it sitting in my inbox to write today as a reminder. And we are seeing some upgraders back. It's been interesting. I actually caught up with a very long-term friend in the broking industry. We had a chat about this as well this week. And he's got a very established business. And yeah, we sort of both talked that we've, seen quite a few clients come back on the bigger end of the property market, which we haven't seen too much for the last 2-3 years. And so it's trickling back. We're doing a lot of sort of bridging loans, which is very hard to pull off unless you've got a lot of equity, to be fair. We're getting a lot of clients ready to consider the upgrade. But, when you look at the ASX tracker, I mean, I look at that daily. There's a bunch of things that, I'll sort of quickly type in and just get my little reference point for the day. Because I think, data's great, but when you have this sort of knowledge of referencing it over time, I think you can start to pick up movements because you're sort of tracking the trend. And I mean, if you look at it now, I'm just bringing it up while I'm talking, we're looking at maybe a rate cut sometime, next year. Like, that's quite a big difference, Pete. That's maybe 2 rate cuts, maybe at least one less than what people expected, and maybe none till 2026. Now, what's the impact of that? Will it affect investors? I don't think so. I think investors, if they put it off for years and they've been wanting to do it, it's still in a downward trend. And a lot of them are, house price expectations really high. So I reckon investors are going to still be really strong coming into 2026. I think first-time buyers undoubtedly will. And I think a lot of portfolio investors are tapped out. Borrowing capacity is just really tight, but wage growth started to come through, and maybe some capacity starting to get better every time there's a rate cut. So maybe they've got the capacity to buy more. But ultimately, the upgraders in this sort of environment, I think they're going to be tentative. So what does that really mean? I think we're going to see, a lot of people upgrading is probably just going to sit on their hands more, And so I think for the rest of this year, listings are going to be really tight in the housing market because a lot of upgraders have got houses. And even in the first 6 months of next year, I think they're going to be a wait and see approach. And so this sort of dire listing numbers, I think it's going to continue at least till the middle of next year, particularly in the housing market. But, a long answer, Pete. I will let you say something at some point. But I do think your other point in that headline was it's going to be a bottom-up boom. And that's exactly what I've been thinking as well. I think you're going to find that, as this 5% deposit comes in, you're going to create this little mini increase in prices. Who are they going to buy from? Well, often they're going to buy from either a couple or a family that wants to then get into a bigger apartment or a house, or they're going to sell off an investor. And then the investors may recycle that money to pay off their home loan, upgrade their house, or go and back and buy another investment property. Sometimes it makes sense from a debt point of view to recycle debt. So I think that you'll find that this first transaction, as it flows through, will have these, second and third consequences. And I do think what you will do is allow people to have the ability to upgrade. So for example, if you bought an apartment at, I don't know, $1 million, and now you can sell that at 135, 14 or something, in Sydney, I'm talking, and you had a loan of 800 and you've now got that loan at say 600. Well, a few months ago, maybe you couldn't upgrade, but now you can because you'd clear 700 grand, and that's enough to do the upgrade safely. So I think that's what we're going to see, Pete, is a bottom up boom. But I think in property markets, they're slow moving. They just don't, like share markets, people don't just sell and buy very quickly.
Yeah, completely. Yeah, I mean, don't apologise. I could listen to you chat all day, Chris, on property and what's happening in demographics and markets. I think you're right. Since last time we spoke, actually, we had another round of inflation data for August, just on the monthly inflation gauge, and there was just a bit more inflation around. And the RBA did reference in the decision over the past week that the decline in underlying inflation seems to have slowed down a bit. So when that announcement was made, there was a bit of repricing. I think if you looked at the 3-year bond yield, it kind of jumped by about 6 basis points or so. But by the end of the press conference and by close of business, that had sort of unwound, went all the way back to where it began. But I think you're right. If you look at market pricing, there isn't a a full interest rate cut now priced in until May 2026. So that might prove to be a bit on the hawkish side, but certainly I don't think there's any rush from here for the Reserve Bank to cut interest rates. It was quite interesting listening to the press conference. Dave Taylor from ABC News Business got quite fired up talking about the RBA stoking housing prices and pumping the market through the pandemic. And it was quite interesting just listening to Michelle Bullock's response on that. Firstly, that the RBA doesn't target housing prices, even though monetary policy, the mechanism does work through housing, I guess, in terms of the wealth effect and also the supply response. But it was interesting to hear her say that the housing supply turnaround could prove to be years away. And it does seem to be, when you looked at like the building approvals figures, dropped again this month after a big drop last month. And it just seems that, yes, we've had rising prices in the market, but supply is very slow to respond. Tarek Brooker, who's an independent analyst and now contributes to Macro Business, has been saying that maybe the housing shortage, rental vacancies hit an all-time low this month. Well, it could be next decade before we actually get that housing shortage fixed. So, that's the environment we're in. As you said, it's yes, interest rates might not fall much further, but there's just such a shortage of housing that it's creating a bit more urgency, especially with people at the first home buyer level who are just keen to get on the ladder.
It's interesting, Pete. You also sent an article through, can we add density without wrecking our suburbs? And it was actually a really good article. I sort of track, a lot of the, architects sort of work, Housing Magazine. I sort of really want to track the modern, what's our sort of modern way of building. And that's a really good way, I think, to see some, really nice design, really, because we're very fortunate in Australia. I feel we've got extremely talented architects. And so I think I did an article a couple of weeks ago around Sydney and, how I feel like we do need to evolve as a city to start to make housing and property more fair to lots of different demographics who are getting pushed out all the way from the bottom end and further and further up. And in all generations, to be honest, there's issues. And I do think that's rebuilding and that's adding more supply across our city, not just greenfield estates, not just high rise in other areas where there's high rise, but also in our missing middle. And I do think we're going to have to change to give up some of what we thought the way the city was going to build out. I think there's going to have to be a new version of Sydney. And I think there's an attitude that density can't be done well because we didn't do it well in the past. I think, things have moved on. We've sort of learned from the mistakes, I feel. I think we know that, yes, we need to add supply, but they need to be built really well so they last. That'll happen naturally because it'll be driven by owner-occupiers, not an investor boom. And I also think it'll in the premium suburbs, people are going to demand a high-quality product, everything from the way it looks to privacy to the sustainability of it. And so add an attitude that density can't be done well and that it's going to destroy our suburbs. I just think it's a bit naive. And I think that report that you sort of shared there's some brilliant designs, the way people are going about townhouses. And if you look at the pattern work designs that the New South Wales government has sort of introduced that you can buy for $1, they're amazing. You can't knock them. Like they're very, very nice. And we've been doing density for over 100 years. And so I don't think that, we can't do density well. We were doing it well back then. If you look at the terraces, and while they might not be the way we'd build today, they were very practical back then. So, I think this sort of, the changing of our city, I think there's a lot of people holding on to status quo and what things used to be like, not willing to sort of move with the times and accept that things have to change.
I think people aren't so keen on the Manhattanization of the cities, but if you go to a lot of European capitals, that medium density is delivered a lot better, and I think that's potentially where things might head. I think the zoning has to allow for it, as you said, in some of those NIMBY suburbs. I think New South Wales Liberal government has made some noises this week about potentially embracing YIMBYism and allowing more supply. And I think that's has to be driven in that way, and people need to stop blocking it. So let's crack on with our big three property news stories of the week. So if you're not familiar, Sunday at 7 a.m. in your podcast player, this is what we do on 2 Cents, the big three property news stories of the week. But stick around, because at the end we'll cover some of your listener questions as well in our Q&A segment. So first story this week in the Fin Review, desperate first home buyers spend $804,000 in Sydney. According to Resolve Finance, that's $100,000 more over the past year, based on what their analysis showed. So first home buyers are spending a lot more. There was also an article in realestate.com.au this week suggesting that housing prices have just jumped by 50 grand in the first home buyer markets. Certainly chatting to Kate Bakos in Melbourne, she was saying that around that 700k price point, that's definitely been seen in recent weeks. Andrew Freed, who I work with in Brisbane, has said the same thing. Actually, in suburbia, first home buyer markets have just jumped in the last month or so as people are trying to front run this first home buyer deposit scheme. I'd be interested to get your take, Chris, as somebody who's in the mortgage market. I suppose, what are you seeing? Because I guess what everyone's sort of saying online is, well, this is our version of subprime. We could see negative equity down the track. I mean, are people actually affording this? Are they getting help from parents? And because I suppose it seems that this is going to be something that isn't reversed. It's going to become embedded in the system. Most of the people in the industry I speak to are thinking, well, yes, you could get a boom, and then when things come back, maybe there's some risk of negative equity down the track. But when you look at the cohorts who've sort of defaulted on mortgages in recent times, it's mostly been things like property developers or very large portfolio investors. It's been less so, I guess, first home buyers, because younger skilled workers can usually find a way to make payments. And even if they get into arrears, banks have been more inclined to offer mortgage holidays. But anyway, just some thoughts. I'd be interested to know how you're finding first home buyers are affording these entry price points, particularly in Sydney. But also, do you think there's some risks here getting embedded into the system?
I think there's definitely an argument that you're going to see a lot of first home buyers take on huge mortgages that they can't afford, and they're all going to default. And you got to put yourself in the first home buyer's shoes, right? They've just gone and paid stamp duty often, sometimes not, but they've just gone and saved up their 5% deposit. That's everything they've got, right? That's their life savings. And, and if they go put that into a property, do you think they're going to want to lose that property? No way. They're going to change their behavior. Yeah, they might take a few months to adjust to repayments, and maybe there's issues with their job, and maybe they did over leverage, and maybe they have to get bailed out from family, and maybe they have to sell in a year or two time because, yeah, they did sort of over leverage. But when you look at current bank lending, around 5 times income, I think it's quite conservative. I think when you look at the actual mortgage repayments, and then you look at exactly what someone's net take-home income is, there's still a huge buffer in there, and there's still a huge amount. And yes, they need to make lifestyle shifts. Maybe they can't have as much fun on weekends, and they have to substitute a dinner for a picnic, or they have to maybe don't go on that holiday, and they have to sort of maybe holiday at home, or holiday, in a car trip away rather than a flight away. Maybe they, have to potentially cut back on their clothes or whatever but there's still a huge amount left over in there. And I don't think, yes, its cost of living's gone up, but I do think that people can afford it. And I think it's a bit naive, and I think it's not giving enough credit to the next generation that they're going to actually be able to take control of that mortgage, and are going to make the lifestyle compromises they need to make to stay on top of that mortgage. And there's more of a risk when rates go up. I think the people that really got caught out were in 21 and 2022, when the RBA sort of came out and said, rates are going to stay low forever, blah, blah, blah. And, that a lot of people leveraged up because you were leveraging on a much higher multiple of income and at much lower rates. And, you got caught out. And so a lot of people, hadn't factored in the lifestyle compromise they had to make to be able to stay in their homes. But if you look at what happened, arrears rates didn't jump. People still stayed in their properties. And, you didn't see this mass selling. And so I think it's always, a lot of property doomsdayers jump on these sort of high LVR loans and say, oh, they're all going to default. It's a huge risk. I just don't believe it. And I think the first home buyers who do take advantage of it will be money conscious. If you look at even podcasts and the self-education and people taking control of their financial futures, you would have to say, you have to give credit to the next generation. They are self-learners. They are absolutely trying to educate themselves. And so, my thoughts are with them, to be honest.
I think yes, a good point. I guess when you look at the causes of mortgage default, yes, very high and rising interest rates, which is not the current environment. But if you get a big oversupply of properties and landlords just can't find tenants, so that's a risky time. But at the moment, we've got the opposite problem, a shortage. And I guess if you get very high rates of unemployment and potentially youth unemployment, then that would be another risk. But at the moment, we're pretty much below what would be termed full employment, so effectively a job for everybody who wants or needs one. So I guess that would be the X factor if we get a big spike in unemployment. But at the moment, it's stayed very low, much lower than I would have expected, really, at 4.2%. So that's probably the metric to watch. I think, when you look at mortgage stress reports, they often say if somebody goes over 30% of their income, they're in mortgage stress. But then when I look back over my journey, has there been times where I spent more than 30% of my income on a mortgage? Yeah, too right, there was. So if you think back to before the global financial crisis, we had mortgage rates at nearly 10% in some cases, and it was painful. But I guess it doesn't mean you automatically go into arrears or default if you go from 30 to 33% or something of your income being spent on a mortgage. It does mean you have to cut back on consumption. And yes, you're right, the lending standards are nothing like what they were pre-global financial crisis. It's much tighter. And I'm not just saying that. Anyone who's been through the mortgage process in recent years will testify to that, because there's just the checks are much more stringent. And actually, yes, you're right. The capacity of people to borrow is much more constrained than it once was. So I guess those are factors that work in the other way. Let's have a look at this second story of the week. Australia is a dangerous place as the AI boom ramps up. So this is ABC News Business. So yeah, we have seen in recent weeks and months that some of the banks have been offshoring or laying off some staff. And it's estimated in the article that about 30,000 people in Australia now work in AI. I guess at the global level, the IMF has said that maybe 300 million full-time roles could be impacted by AI, mainly sort of the administrative or clerical roles. I guess the optimistic view would be a lot of those roles would evolve rather than just go completely. And that, I suppose that's what's happened historically. People have talked about, robots coming for our jobs and automation. And yet here we are today with a 4% unemployment rate. It hasn't stopped us finding ways for people for capitalism to keep creating jobs. But obviously there's going to be some massive disruption from AI. There'll be some big changes to what people do for work, maybe where they choose for work. Certainly, I've been I was reading in Roy Morgan research this week that although Sydney and Brisbane have seen the CBDs effectively go back to their pre-pandemic levels, it hasn't happened in Melbourne. Maybe people just aren't going back to the office. Certainly they're not going back 5 days a week, but maybe these are some of the impacts of the technology and AI boom. Chris, obviously you're somebody who thinks a lot about this stuff on your podcast. Have you thought about AI and the impact on the workforce and demographics and real estate? What are your sort of hot takes?
Oh, it's not a popular one, to be honest. I think it's going to take time. I think it's, I think it was a bit of a fad, like a couple of, maybe at the start of this year, everyone's like, oh my God, this is really good, because they first started using AI and they're like, wow, I didn't think this was going to ever happen. And they didn't really thought about it. And then all of a sudden it was very topical. So I do think there was a bit of a spike in interest at the start of the year. I'd be interested to look at ChatGPT stats, to be honest. Are people using it less now than they were at the start of the year, when everyone was hyping around it? I mean, I still use it pretty much all day. I don't search. I'll go straight to ChatGPT and, I have a conversation with it. So I absolutely love it. But I do think that, it will affect parts of the market, and I do think it makes inequality worse. I do think that people who are basically on, benefiting from the AI wave, and there'll be a lot of people who don't, but unfortunately, I think the people who are benefiting from it, the people who are investing in it now, and the people who have got businesses that can benefit from it. And so I do think it makes inequality a lot worse. And I do think there's going to be people who are marginalized from it. So I do think that may change our property market. You know, if you start to see higher income growth for certain segments of the markets, and particularly people who have, benefit from that type of knowledge, and it can be more productive. And I do think it will really, affect others. But there's lots of jobs that AI can't do. And so maybe there's, you've just got to be really conscious that if your job is going to be affected, maybe it's time to pivot, get ahead of it, start training, start reorganizing the way that you think about your future career rather than just trying to hold on. So I think they're the ones who need to think about it the most. I mean, we're testing a lot of it. We're trying to as a business. And I think it's one of those like the work from home chat, Pete. We're just going to have to just keep tracking this. I don't think it's going to be like, by January, there's, the world's ending. But I do think that, over the next 2 to 3 years, we'll start to see some major impacts from it. And, but my take is if you go back 5-10 years time, I think it'll make inequality a lot worse and reward part of the income spectrum a lot more than others. And that would be my concern.
Yeah, you definitely need to be aware from a career perspective of where the disruption's coming. And I think you need to, work on your unique skill set, I guess, to protect yourself from that. Just, I tend to use Grok quite a lot. And it's interesting, as you said, with ChatGPT, one of the issues is that if somebody writes something which is incorrect on the internet, sometimes that gets picked up on ChatGPT. I was chatting to Kate Bakos down in Melbourne this week, and she was saying, somebody written an article that contains some inaccuracies, but when you go to ChatGPT, it obviously screens and picks up information that isn't necessarily correct. So, I think obviously you need to use it judiciously, but quite interesting. I was doing, just as a sort of property anecdote, we're doing a renovation at the moment, and my wife and I were discussing the rapidly exploding overruns in our budget. We were looking at some Tarkett flooring, and I wasn't really sure on cost, and I just threw it into Grok, and it gave me such a good overview of cost per square meter, how to get professionals to install it, the cost of offcuts, and it was all the research I could have done that would have taken me a long time. It was just done in a click of a button. So there's definitely some efficiencies in there. I guess you need to think about how you can make it work for you, and rather than be disrupted, because obviously AI isn't inherently a good or bad thing. It's really how people use it that's going to be the challenge. If you look at stock market valuations, we're in absolute eye-watering territory for AI and AI stocks. Obviously, there's a lot of excitement out there about the potential. But as you said, it might be a case of the haves and the have-nots. Let's finish up with our third story this week. Cities being eyed by investors. An article in Domain, they sort of pointed out that Sydney has had higher capital growth than Melbourne in recent years, but you've got to look as an investor at the total return, and investors chasing rental yields will probably not really be looking at cities like Sydney, where rental yields tend to be lower than in the regions. In recent years, Brisbane has done well on both counts because it's had reasonable rental yields and capital growth. But I suppose when you're an investor, you've got to look at everything. You've got to look at the total costs, including land tax and other holding costs. Out of interest, Chris, I mean, because we're sort of operating sort of southeast Queensland and New South Wales, it's a bit self-selecting. The people that come to us are mostly interested just in those markets. But I do know some investors have been going interstate to suburban Melbourne, for example, for some sort of good entry-level prices, and likewise some developers doing the same. But where are people sort of eyeing up as potential investment locations? I did see from the RBA's financial aggregates this week that investor credit growth is really it's a decade highs now, and it's really driving housing credit. So investors are going to be a key part of this housing cycle. Where do you think they're going to be looking?
Yeah, I think that as a business, we didn't try to help our clients invest in what we call momentum investing / market speculation. And I mean, maybe it's not speculation because you are more investing on where you think momentum is going to build. But what you're trying to capture is short-term momentum rather than long-term assets that are buy and hold. And I do think it has a place in someone's property portfolio. Personally, I think there's challenges with it, buying and selling and capital gains tax and then re-entering markets and the risk of getting it wrong or the risk of entering too late or leaving too early. Like there's a strategy there, but I think people have done really well over the last few years because there's been ridiculous momentum in regional markets and particularly in Perth and Adelaide. So I think that a lot of investors will try to replicate that strategy. But personally, I think there's challenges because a lot of the markets they have gone to have also run, and you're running out of choices where, something was maybe very well priced, for example, like a Perth or even a Darwin, and people have been investing up there for the last 12 months. So, and I also think what's happened is there's been a proliferation of investment-focused buyers agents who have also jumped on this momentum wave, and they're almost, Renee Rivkin style pumping it up. So that's one type of investing. I think, though, that there's always been the other type of investor, which is a buy and hold. I've wanted to get an investment property. I want to get something that I can hold for, 20 to 30 years. And I think more and more people are going to do that just because putting money into super is really tough. And then there's just the benefits of leverage when you go into resi property. And I think what you're going to see is that investors are going to potentially play it a little bit more safer, as they always do. And I think they're going to start to compete where first home buyers are just because of budget. It's pretty brave in this environment of 5% interest rates to go and take big mortgages on because the negative cash flows there. But every time there's a rate cut, I think investors are going to potentially be more comfortable to spend more. The interesting article which you started to start, Pete, is that rents have actually been going back up, a receleration of rents, which is not what the government wants or the RBA really. And I think what you're going to start to see is there is going to be some investors coming in competing with first-home buyers, but I think a lot of the properties they're going to buy is off investors. And so I don't think they're going to be replacing one for one. I think you're going to see a continual undersupply of rental supply, particularly because a lot of investors won't want to buy the apartments. They've sort of read enough articles now to say, hey, maybe you should buy an older house in the fringes rather than near the city. And so that would be my take. I think Melbourne is. Pippa just did a report this week, Pete. We haven't mentioned it in the article. It's like investment sentiment. Melbourne's the least attractive place to invest, but it's also right now the most populous place to invest. So that's a bit of a irony. Investors think that it's anti-investor, but then they're also thinking they want to invest there. And
well, cause and effect, I suppose. Yes, if you push investors away, I guess less competition, slightly lower prices potentially. And I guess that's how the cycles work. But interesting. Yeah, I mean, it tends to, in those Pippa surveys, Queensland always seems to feature right at the top for investors because a lot of the people who are doing the investing are based in Sydney and Melbourne, and they're looking for a diversifier. So that's a pretty interesting stat. So let's wrap up with a couple of your listener questions. We've probably got time for two here. So here's one from Bin Chicken. There's a lot of good things going on in Queensland at the moment, and not just in the sport. Yes, interesting to see Broncos making the grand final as well. It's all happening in Brizzy at the moment. Is Queensland still a good place to invest? Yeah, I think it is. I think people, as you said there, Chris, you probably need to take a longer term view and not expect the results that people have seen in the last, really since the pandemic, because there was a sort of unusual spike in activity from 2020. So I think, yes, but with a caveat, you need to focus on buying the right property types for the markets you're buying in. And there's a lot of sort of unseen risks in markets in Queensland. There's obviously flood locations that a lot of people would be aware of these days. Also, we've talked on previous episodes about bushfires. But yeah, I just think in terms of your property portfolio in general, if you're growing an investment portfolio, you can end up with a lot of repairs and headaches and things like that. So I think, yes, but you probably need to make sure you buy the right property type and location and take a longer term view. I think you don't just want to be piling in blind because, prices are higher than they were 5 years ago. And there's a long history of people losing money in Queensland property by going into some of the sort of big projects and falling for some of the schemes out there. What do you reckon, Chris?
Look, I think is it a good place to invest in Queensland? I would say absolutely. The reason I say that is you think about how many people are in Sydney and Melbourne. As people get older, they want to be away from the cold a little bit more. And there's just a natural interstate migration that just has happened for decades up towards the sunny state. And if you add on top of that, the, city refugees that are basically moving out of our cities, because, of basically a lack of security and stability and, a lifestyle they want to live. I think this is the real issue you've got in Sydney. And I think Melbourne, it also has that sort of, issue a little bit with the negativity down there. I would say that it's something the monkey they're trying to get off their back. But I would think is, if you think particularly Sydney, I think because of the time zone and, not being sort of a delay there as well, I also think it's great an economy to invest in and build a team in, particularly if wages are a little bit cheaper up there. So I think the economy will do really well. I think you'll see interstate migration really well on top of all the sort of gentrification they're doing as a city in preparation for the Olympics. And I think, there's particularly even the Gold Coast and the Sunny Coast, I think will piggyback off that Brisbane story, particularly if they upgrade infrastructure to make those sort of commutes better as well. And so I think if you come back in 2035, is Brisbane a much, bigger and better and a more expensive city than today? I think so. And I think that that'll be driven often. Also piggybacking off the sort of potential rise in Sydney prices as well. A lot of people will take their money and run up the coast. We saw that in 21, 22, Pete. I don't know if you sort of remember that. A lot of people bailed out of Sydney because they could sell in a real peak market. That gave them a bit of money to put in their super, and then that money, the rest of the money, they could buy something up the coast to sort of live in retirement. And I think that will naturally happen more and more as people get older and the baby boomers want to cash out of Sydney.
Oh, you completely. I think if you look at interstate migration figures in Australia, yes, there's people go to and from WA and a little bit to Victoria, but it's really a story of New South Wales up to Queensland. It just ebbs and flows depending on affordability. And once every decade or so, there's a big surge of people deciding to cash in Sydney and New South Wales and move up to Gold Coast or Sunshine Coast or Brisbane. And that seems to be the demographic trend in Australia. We're just not building enough. I guess that's the other thing. In southeast Queensland, population growth in some areas is 2.5%, and we're not building anything like enough stock. So last question for this week, and then we'll wrap up. From cost of living, special levies keep cropping up. Is this a problem for my investment portfolio? I own a couple of units in Sydney. Look, special levies haven't been uncommon in recent years because building costs have gone up. Repairs and so on, but also insurances have taken a huge leap in a lot of cases, maybe 50% some people have experienced. There's also been some stories of sort of bigger issues like cladding and building defects in Australia, particularly in Sydney. So I think it depends really. If they're just sort of one-off levies, because the cost of repairs and insurance have gone up, well, that's not necessarily a big issue as long as you can afford it. I think if special levies are cropping up because of blatant mismanagement of the body corporate or the strata scheme, and if there's sort of major critical defects in the building, well, that's a whole other story. So I think it's more of a judgment call rather than a yes or no answer. I think a lot of people have experienced special levies in recent years just because the cost of management has gone up. But if it's a more serious issue, then that might warrant taking a different stance. But what do you think, Chris?
It's an interesting one. I mean, there's a lot of people talking about buildings that were built, say, the 90s to the 2015 sort of boom. There's an easy decision to try to avoid those apartments, to be honest, often. The building quality, haven't aged well, their designed elements. And, there is definitely, little nuggets of gold within that period that absolutely, you don't want to completely discard, but often a lot of them you can. But if you think about the apartment builds that were happening in the 60s and 70s, all these Art Deco and the brick builds that, a low density and small number of units per block, just due to the city was much different 50 years ago. you think, these are solid. They've been around 50, 60 years. They can't possibly be problems. But I think that's also sort of missing, that they're 50, 60, 70 years old now, and things naturally get older and they start to have issues. Everything from concrete cancer to windows, structural beams, to the list goes on. The ground's moved, so I've got a friend client who does repair work on these apartments. And I've picked his brain in a bit of detail around this as well. And, that's his job. He doesn't fix the new builds. He fixes the old builds. And there's a lot of repairs happening across Sydney for the old builds. And so I do think you need to be conscious of that and really check the Strata report and really just make sure you know what you're buying. Because, if you do get a building where it's a huge special levy, and it's just the cost to build, right? Like it was $1 million to fix or $2 million to fix a couple of years ago, it might be 3 or 4, and then that special levy is not 200 grand, it's 400 grand, and people can't afford it when then, these buildings get a bad smell about them and they have become really hard to sell. So even if you can afford it, doesn't mean that you can sell the apartment. And I think there's also an insurance thing going to happen here where you kind of have to do it, because who's liable, right? If you don't fix these things and something goes wrong with the building, particularly the cladding, but also there's other issues. Do you really want to, be liable for that? And I think, maybe we're, touching wood, one fire away or one property falling down or something before some really hard legislation sort of comes in on this as well, because I think a lot of buildings just aren't keeping up the maintenance they really need, because a lot of people are pretty scared and can't afford special levies. And so I think it's a brewing problem, and it's a 2030s sort of thing that'll pop up.
Yeah, I remember, I think if the Strata levies get too high, then buyers just aren't interested. Yeah. I remember the Goldsborough building in Pyrmont that had extremely high levies, and it ended up just being a short stay accommodation because nobody wanted to buy there, and it just wasn't working for the owners either. So that's the risk. I think as well, buying off the plan there's just always more unknowns. I think I've personally only ever bought one brand new property in 2009, but it was already built. I could see it, and obviously in 2009 you could negotiate the prices down. I'd be less keen buying out of a brochure, because then who really knows in terms of building defects. But anyway, I guess we've spoken about that many times. So come and join us on the Rask Community Forum. That's community.rask.com.au. Lots of chat there. And also send in your questions. There's a link in the show notes, and we'll cover those in the weeks ahead. Chris, I'm flying back up to Queensland this weekend. What's on for you?
Blue Mountains, mate. So get the hiking boots on, get the kids walking in nature. It's going to be interesting. We got to push it pretty hard. I've got a little water backpack I'll put on, and I'll see if I can get 6 kilometers out of them. Let's see. I could be that sort of annoying dad.
You can do 6Ks. Just don't stray off the tracks or anything like that. I don't want to be reading in the Sydney Morning Herald. So stay safe, and have a cracking weekend. Thanks for listening, everyone. We'll see you next time around, and do send in your questions, and we'll chat about those as well. Cheers, Chris.
Chat next week, Pete.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.